The wealthiest in the world pay no tax? Well, a really big part of that is real estate investing. And today we're going to talk about 5 key things that real estate investors need to know to make sure they're maximizing their tax strategy. So the first one is depreciation. And depreciation is spread over 27 and a half years for anything that's considered residential. So you as an investor may hear commonly that anything that's 5 units or more is considered commercial property, but for IRS purposes, it is still 27 and a half years depreciation schedule, regardless of how many units you have, because the IRS considers it residential, even though for other purposes like loans, it's considered commercial property. So keep that in mind. 27 and a half years, that depreciation helps to offset the income from the property. The second tool that you can use as an investor is a cost segregation study. And a cost seg is when they take it's either an engineering company or someone who is set up to be a cost segregation company. They go in, they separate the components of the property. So land is always taken out because land is not depreciable, but they will separate things like the HVAC unit and the carpet and cabinets and things that are fixtures in the property from the physical building itself. And so things that are considered to be worn out in a shorter period of time can then be put on either a 5, 7, or 15-year schedule, depending on how they're normally classified, and you can then deduct those in a shorter period of time, which leads us to number 3, bonus depreciation. So bonus depreciation has gone back and forth. Sometimes it's permitted at 100%, other times phased out. Now it's back again. So current tax law has it at 100%, which means if you do a cost segregation study, all of the components that are in 5, 7, or 15-year life can be front-loaded, so to speak, and that deduction taken in the first year. So that gives you a whole bunch more up front, but then obviously less over time. But it can be a nice big chunk write-off if you need a deduction for other purposes, or you can allow it just to continue. So if you do take it up front and you don't need all of that deduction, it can flow through to future years as well. But that bonus depreciation can really juice that return up front, or that deduction up front. The fourth thing is that if you can be classified as a real estate professional. So real estate professional status is anytime you are a full-time investor, or you're a house flipper, or you're a developer, anything that you make your living off of a real estate related activity. For IRS purposes, you're considered a real estate professional. So you do not need a real estate license to be considered a real estate professional. But essentially what this means is that all of the income that you have from real estate related activities, or maybe you have some side income from consulting or something like that, all of the passive losses that you might have created through your depreciation and cost segregation can then balance out all of the income that you're bringing in. So it doesn't matter whether it's passive income or active. If you are classified as a real estate professional, they will balance each other out. So that can make a huge difference for people who are in the real estate trade full time, as many investors either strive to be or already are. Then the fifth thing is a 1031 exchange. And this is talked about quite frequently with investors, but it's also frequently misunderstood. So a 1031 is when you would sell a property and then buy another one without taking possession of the money. That's the key determination, because the moment you take that money, then you have invalidated the exchange. So to do a proper 1031 exchange, you must sell a property, the money goes to an intermediary who then takes it and applies it to the property you are buying on your behalf. And of course, they charge a fee to do that, but that keeps you from having to pay the taxes, the capital gains on the property that you are selling. And of course, you can roll all of that into the new property and delay paying that taxes, which allows your wealth to grow much faster than if you had sold, paid the tax, and then bought a new property. So make sure that you are utilizing a 1031 exchange. And one of the things that I hear most often are misinterpreted is the fact that with a 1031 exchange, it can be any real estate held for investment purposes or any other real estate held for investment purposes. So you could sell a piece of land that you held for investment and buy an apartment building, or you could sell an apartment building and buy an industrial building. So it just needs to be held for investment purposes. But the minute you take that money and go buy a house at the beach that you plan to live in all the time, no longer an investment. So it's very easy to find a replacement if you know that you can actually have any investment in real estate for any other. So then also a bonus is that, of course, as investors, you're deducting everything for that property except the principal paydown. So your interest that you're paying and all the property taxes and the insurance and all that stuff is deductible in order to reduce the amount that you are actually will owe taxes on at the end of the day. And that is how real estate professionals avoid paying taxes and can accumulate much more wealth quickly because of that preferred tax treatment. So I hope this video brought you some value. If you're looking for investments within Pennsylvania or Maryland, please reach out to us. We're always happy to help. Please comment, like, and share, and we'll see you soon.